Right now, something is happening inside the silver vaults of New York that most people have no idea about. COMEX registered silver just dropped below 89 million ounces. At the current rate of withdrawal, that is 20 million ounces leaving every single month. Do the math. That gives the vaults less than 5 months before they run dry. And at the same time, Shanghai is buying physical silver at prices $8 to $10 above what New York is charging. So why is the Western price still being pushed down? That is exactly what we are going to break down today. And by the end of this video, you will understand why the data coming out of COMEX right now may be the clearest setup silver has ever shown. Welcome to Dose of Silver. If you are new here, this channel is for people who want to understand what is actually happening in the silver market, not what the mainstream wants you to believe. Hit subscribe and let us get into it. Let us start with the numbers because the numbers do not lie. At the start of September 2025, COMEX had 200 million ounces of registered silver sitting in its New York vaults. Registered means metal that is actually available for delivery, not paper, not promises, real physical silver. Today, that number sits at 89 million ounces. That is 111 million ounces gone in just 5.5 months. Think about what that means. Every single month, 20 million ounces are being pulled out of those vaults. People are not rolling over their contracts and accepting cash. They are demanding the actual metal. They are taking physical delivery. And here's where it gets serious. Right now, there are March 2026 futures contracts on COMEX representing 366 million ounces of silver that are due for delivery. The vault only holds 89 to 102 million ounces. That is less than 1/3 of what is owed. Even if only 20% of those contract holders show up and say, "Give me my silver," COMEX does not have enough to cover it. Now, some people will say, well, there is also eligible silver in the vaults. That is true. Eligible silver is metal that meets the exchange standards but has not been officially registered for delivery yet. In theory, it can be converted. But here is the problem. The owners of that eligible silver have to voluntarily move it into the registered category. They cannot be forced, and right now, many of them are choosing to hold it, not release it. Why? Because they know what the metal is worth. They see the same data you are looking at right now. So we have a situation where paper obligations are piling up faster than physical metal can cover them. Every single day that the vaults get lighter, the pressure builds. And at some point, that pressure has to go somewhere. The question is not whether this matters. It does. The question is when the market finally prices it in. Because right now, Western futures prices are being held down even as the vaults empty out at historic speed. That gap between reality and price cannot last forever. And the COMEX data is now confirming that we are getting very close to the point where something has to give. Now let us talk about what is happening on the other side of the world. Because what Shanghai is doing right now tells you everything about where the real demand is. Physical silver in Shanghai is currently trading at $8 to $10 above the Western spot price. That is not a small gap. That is a massive premium. And it has been sitting there for weeks. Under normal market conditions, that kind of gap should not exist. If silver is cheaper in New York than in Shanghai, traders should simply buy it in New York, ship it to Shanghai, and pocket the difference. That is basic arbitrage. It should close the gap quickly, but it is not closing. Why? 2 reasons. Capital controls and logistics. China has restrictions on how freely metal can flow in and out of the country, and the shipping and insurance costs to move physical silver across the Pacific eat into the profits. So the arbitrage trade that should balance the market is not working at full speed. What that means is simple. Shanghai buyers are so desperate for physical silver that they are willing to pay a premium that the global system cannot arbitrage away. That is not speculation. That is real structural demand. And it is not just China. India has seen massive ETF inflows into silver funds. Emerging market demand for physical metal is rising. The East is absorbing silver at a rate that Western markets are not prepared for. Now here is what makes this even more important. Shanghai is not just a buyer. It is becoming a price setter. As Western vaults deplete and the paper market gets stretched thin, Asian physical markets are gaining influence over where silver actually trades. The price discovery process is shifting. For decades, COMEX set the global silver price. New York said what silver was worth and the world followed. But when COMEX vaults are near empty and physical buyers in Asia are paying $10 more than the futures price, you have to ask yourself which price is real. The futures price reflects paper contracts. The Shanghai price reflects someone actually wanting physical metal in their hand right now. And right now, that person in Shanghai is willing to pay far more. This divergence between East and West is one of the clearest signals in the silver market today. And historically, when the physical market and the paper market this far apart for this long, the paper price has always adjusted. Always. Here is something that mainstream financial news will not explain to you clearly. When silver surged toward $120 per ounce in late January 2026, CME Group, the company that runs COMEX, responded by raising margin requirements. They raised them to 60%. What does that mean? It means that if you want to hold a silver futures contract, you now have to put up 60 cents in collateral for every dollar of exposure. That is an enormous amount of capital. Most small and medium traders simply cannot afford that. They get margin calls and they are forced to sell. And that forced selling drove the price back down. Not because the fundamentals changed, not because physical demand disappeared, not because the vaults suddenly filled up again. The price dropped because leveraged paper traders were legally forced to liquidate their positions. This is one of the oldest tools in the playbook. When a commodity starts moving too fast, exchanges can raise margins to slow down the rally. It does not fix the underlying supply problem. It just buys time. Think of it this way. Silver is like a spring that has been pushed down. The margin hike is someone sitting on that spring with extra weight. The spring does not lose its energy. It just waits. And when the weight is removed, or when the spring becomes strong enough to push back, the release is fast and violent. After the margin hike crushed the price from $120 down toward the $70 to $80 range, something interesting happened. Open interest did not collapse. It stayed elevated. Between 85,000 and 91,000 contracts remained open on the March 2026 delivery contract. That represents theoretical delivery obligations of 425 to 455 million ounces, against an available vault inventory of roughly 89 to 102 million ounces. The math does not work, and yet the contracts are still there. There is also something worth noting about JP Morgan's behavior during this period. In early January, JP Morgan issued 99% of delivery notices for over 8 million ounces through 1,624 contracts in a single reporting period. When one institution is responsible for nearly all delivery issuances in a short window, it tells you that metal is being moved in a deliberate and strategic way. Large players understand what is happening. They are positioning for something. The paper market is showing stress cracks. The margin games are proof that authorities are trying to manage the pace of change. But managing pace is not the same as fixing the problem. The vault is still emptying, the Shanghai premium is still there, and the delivery obligations are still building. Let us put all of this together and be very clear about what the data is saying. COMEX registered silver is down more than 70% from its 2021 high. It is currently losing 20 million ounces per month. At that pace, registered inventory hits zero within 4 to 5 months unless something changes dramatically. Shanghai physical silver is trading at $8 to $10 above Western spot prices. That premium is persistent. It cannot be arbitraged away. It represents real structural demand from the largest silver-consuming economy in the world. The March 2026 futures contract carries over 366 million ounces in open interest against roughly 89 to 102 million ounces of available physical metal. That ratio is worse than 3 to 1. In history, no commodity exchange has survived a delivery ratio this extreme without a hard reset in price. 5 consecutive years of global silver supply deficits. The 2026 shortfall is projected to reach nearly 200 million ounces. Industrial demand from solar panels, electric vehicles, AI hardware, and solid-state battery technology is accelerating. Supply is not keeping up. China has classified silver as a strategic material and restricted exports. The U.S. has added silver to its critical minerals list. Governments do not add things to strategic materials lists when supply is abundant. Now here is what all of this means for price. At some point, the gap between the paper price and physical reality has to close. It always does. The only question is how and when. It could close through a sudden sharp price spike when delivery stress becomes undeniable. It could close through a gradual repricing as more investors move from paper ETFs to physical holdings. It could close through a default or force majeure event on a futures exchange. Or it could close through a combination of all three. What the COMEX data confirmed this week is that we are moving deeper into the danger zone every single day. The vaults are not refilling. The Eastern demand is not slowing. The paper obligations are not shrinking. If you are watching this and wondering what to do with this information, here is a simple way to think about it. The smartest money in the world, institutions, sovereign funds, and large traders, is not sitting in silver paper ETFs right now. They are moving into allocated physical silver. Sprott doubled its physical silver fund capital raise to $2 billion. That is a clear signal from institutional money about where the value is. The COMEX setup is now confirmed. The data is on the table. This is not a rumor. This is not speculation. These are vault reports, delivery notices, and exchange filings, and they are all pointing in the same direction. The explosive move that everyone has been asking about may not come from hype. It may come from math. Simple, unavoidable, physical math. Drop a comment below. Do you think COMEX can hold through March, or does the delivery pressure finally break through? Write hold or break below. I want to see where this community stands. And if this video helped you understand what is actually happening in the silver market right now, share it with someone who needs to see it. Most people have no idea this data even exists. That is exactly why this channel is here.